Okay, hello. So I am going to go ahead and get us started this evening, and as people join in, they can. What I want to start with is introducing myself, and my name is Nancy Brown. I'm the president and CEO of the Winona Community Foundation. In my career path, I had the opportunity to get to learn about estate planning through a process called charitable estate planning. And that is based on a philosophy that everyone has the capacity to make a gift in their estate plan if they only knew how. And as I worked through that process, what I really learned is that people don't really understand what the basic components of estate planning are, and that will sometimes hold them back in getting their plans done. So what I've got today is just a really broad overview that hopefully when you, well, I'll go to my slide deck here really quick, but I'll just give you a couple of what I would call logistics. This is a webinar format, which is very different from Zoom, which it means that I can talk to you and you can hear me, but I can't hear you. And so if you look on your screen, you'll see that there is a chat, and I am going to try and monitor the chat as best as I can. So if you do have questions, please ask them. And if you didn't get something asked, you can give me a call and I can hopefully help you out. Other than that, I am going to do a very quick poll, and it's a small group, but I don't think that you'll identify yourself, but I am just wondering if you would answer, do you have a written estate plan? Okay. All right. So here's the deal. More than half of the adult population in the United States does not have any kind of plan. And the truth is that if you don't have a plan, it's the state that you're living in that is going to take over and execute that plan for you. One of our most recently settled estates was Prince, and Prince died in what they called intestate, which means that he had no written plan. And so if you recall, there were some arguments and debates and trying to say who should be getting these funds. And you don't want to do that to your heirs. You want to set them up for love and a process where they can remember you fondly, and that you have done things that have provided for them as they pass. So I am going to, can I close this poll? This is like I said, oh, I'm going to delete it. Here we go. I'm going to delete it. And I'm going to share my materials here. It's hopefully not too long. And I'm going to open up my chat box here and welcome you to the Winona Community Foundation. And, oh, why am I not? Oh, looks like I have to go all the way back to the beginning. I apologize for that. But this is estate planning in a nutshell. And the first thing I need to share is that I am not an attorney. I am not an accountant. I'm not licensed to provide legal or accounting advice. And so this information is just provided for general informational purposes and should be used to prepare yourself to have a conversation with your attorney or accountant or a financial advisor. Everyone's situation is unique. And my unique situation is, like I said, over time, I've acquired this information just through the various jobs that I've had, in particular, the charitable estate planning job that I had with Thompson and Associates. So as a refresher, our goals for tonight are to articulate what makes up an estate. And I think that if you walk away with anything, this is going to be key, because once you understand what makes up your estate, it's going to make it more comfortable for you to have conversations about how you want to pass those assets on to your heirs. I would be remiss if I didn't talk about how charitable tools can sometimes help transfer assets to your heirs. And then also, if you are looking at making charitable contributions, what are the best assets to give to charity? So where I want to start is just, what really makes up an estate. And you can see here, it's basically everything that you own of value. And your net worth is all of that stuff minus any assets or any liabilities that you have. So if you have a mortgage, if you have a car loan, if you have a personal line of credit, those types of liabilities are taken away from the total value of your estate. So the types of things that would be held in an estate are land. So maybe it's recreational land, real estate like your home or a second home, or vacation property. Obviously cash, so anything you have in savings, your checking account, CDs, stocks, mutual funds, bonds, life insurance, retirement accounts, and all your personal possessions. And when you think about what are your personal possessions, it's the automobiles, it's the furnishing in your home. You might have antiques or collectibles, jewelry. All those types of things are what actually make up your estate. And when you are looking at an estate and the total value, something that we always hear about are estate taxes. So whether your estate is taxable or not depends on what that net worth is. And right now in 2022, if you are a single person, I'll stop sharing here so you can see me. So if you're a single person, you are able to pass on an estate of $12.06 million without being subject to any kind of estate tax. If you're married in the federal estate tax, you double that. That's $24.12 million that you get to pass on to your heirs without any concern about estate taxes. So who is that? Less than 1% of our population actually has any concern regarding the federal estate tax laws. Something to keep in mind, however, is that even though that's in legislation, it can change. It takes another act of legislation, but it can change. But right now, this is how the tax laws are written. There is a sunset on it, and when it sunsets, it will drop back to where it was at when the current law was put into place. But once that happens, I don't think they're going to let it happen. And common thought is that it'll probably settle in between $3 to $6 million per person. So that's the federal estate tax law. Very few people are going to be subjected to that. However, for those of you that are on this call that live in the state of Minnesota, you are in one of the few or handful of states that do have an estate tax at the state level. And the Minnesota estate tax exemption starts at $3 million. So if you have an estate that's valued at $3,001,001, that $1 is going to be taxed at about 13%. And it goes up the highest percentage at estates that are $10 million and above. The taxing is at 16%. Keep in mind that it is not the entire estate that's being taxed at those rates. It is anything over that first dollar beyond $3 million. The other difference between the federal estate tax and the Minnesota state estate tax is that it is for one estate. So there is no what they call spousal portability. So if you don't utilize your entire estate tax exemption, your surviving spouse doesn't get to use whatever you didn't use. So just as an aside, there is also an annual exclusion for making gifts to individuals, and that's $16 million for an individual. You can make as many gifts of, did I say 16 million? $16,000. So if you make a gift of $16,000 to 20 different people, that doesn't count against you. It doesn't factor against any of your estate tax deductions or exemptions either. A married couple can gift $32,000. So if you are looking at trying to get your estate value, your overall estate value down, you can make gifts to your children, your grandchildren, whomever, during your lifetime and not worry about that impacting your estate tax, and it actually will bring that value of your estate down. Some people talk about inheritance tax. So Bob just asked a question in the chat. Yeah, it's per child. So if you wanted to have, let's say you have 15 grandchildren, you can give each grandchild $16,000. And it won't impact anything. If you're married, you can give $16,000 and your spouse can give $16,000. And you don't have to pay a gift tax, and the child, grandchild, niece, nephew, neighbor, friendly community foundation professional wouldn't pay any taxes on it either. So it's a really good way if you're trying to get your estate down and yet still get assets or gifts to your heirs. You can do it that way during your lifetime. So as far as the other implications to your heirs is that when you hear about estate tax, you'll also hear about inheritance tax. Inheritance tax is the person who receives the inheritance, and they would have to pay a tax on the income from that. Minnesota does not have that. Wisconsin does not have that, so you don't have to worry about that. New Jersey is the state that really likes to tax people quite extensively. So, all right, I'm going to go back to sharing my materials here so we can see what makes up those assets in your estate. So this is another place where I find people can get readily confused, and it's the ways you transfer assets. And the reason this is an important concept to understand is that there's a scary word out there, which really shouldn't be scary, and that is probate. And what probate is a process, it's a legal process of acting on your will or whatever is not controlled by other tools. So when you look at transferring assets, you have the ability to make those designations by your will. So you say, I want my spouse to get it all, and then if my spouse predeceases me, to go to equal shares to my children is very common. So that's all written in your will. Or you can also have a trust, and you have what is known as a revocable trust. Some people are familiar with a living trust or an irrevocable trust. And I'm not going to talk about irrevocable trusts because that just is going to make this more complex. And if you're in that need, then you really do need to be talking to an attorney. Or you can call me and I can walk you through some of it. But a revocable trust basically pulls everything into this an actual entity, a legal entity, and you would put your house in the name of, you would put the house in the name of the trust, your automobiles in the name of the trust, any of your CDs, stocks, all of those types of things get held by your trust. You can change your mind, and that's why it's called revocable. You can say, nope, I don't want all of that stuff in there. And so you can unravel that. Why people use a revocable trust is because they want to avoid probate. And the reason they want to avoid probate is sometimes it can get sticky. Sometimes it can get expensive, particularly if you have a very large estate. And the other is that it protects your privacy. And so if you don't want someone knowing how much you have or who got what, you would want to look at getting a revocable trust, because anything that goes through probate is public. It's public information. And I used to think, well, okay, that's great, but who's going to go down to the county courthouse and say, hey, I want to see Nancy Brown's will? Apparently, there are people who do that, and it is public information because it's gone through probate. You don't have to have all of your assets in a trust, but the reason you have it is so that it does control all those assets. There was a time where revocable trusts were being sold quite frequently. And so people would come in and they would set up these revocable trusts and send you home with your documents. And a lot of them never got funded, which means that people forgot, or they put off putting the house deed in the name of the trust, putting their automobiles in the name of the trust, or they went and they purchased vacation property, or they bought a new vehicle and they put it under their personal name as opposed to the trust. So if you currently have a revocable trust, make sure you've got all of your newest assets named in that trust so that it controls it, because anything that's outside of it will go through probate or through another way to pass your assets. So a will is probate. A trust, it's just an automatic, things get distributed based on what your trust says. The other assets that you might have are those that are controlled by beneficiary statements. So the assets that are controlled by beneficiary statements include life insurance policies, IRAs, and I'm trying to think of another one off the top of my head, but those are the most common. So an IRA, a Roth IRA, a 403B, a 401k, all of those types of things will pass by beneficiary statement. And why that's important to understand is if you have everything going in equal share to your heirs through your will or even through your trust, and you have an asset that's held outside of that trust and it's your IRA, and you've decided that your IRA is going to go to only one of your children, that child will get more assets or more in the inheritance, even if the will says all your assets go in equal shares, because anything controlled by beneficiary statement does not get controlled by the will. Okay. So then there are two other tools that are out there called transfer on death or payable on death, TOD, POD. And what those are, they act like a beneficiary statement. So an example that I always use is my dad has his checking account, and his checking account has a payable on death to his 3 daughters. So it is going to come straight to us, or we would go and access that. We would not have to have it distributed through probate. It would just come directly to us. That's also how transfer on death works. The difference being that it isn't automatically cashed out. So you might transfer a CD on death, because if you paid it on death and you just renewed it, then it gets cashed out anyway. So you'd want to do a transfer on death. And you might do the same thing with a stock. Okay, this is normally where I ask for questions, so feel free to type in there. But so when you go back and you look at listing all the different assets you have, you're going to want to look and say, which one is actually controlled by my will and which one is controlled by my beneficiary statements. So a story that I have from my time in estate planning is that I was reviewing somebody's estate plan, and they had 3 daughters and charity. And the way that they had their estate plan written is their full intent was that each daughter would get a quarter of all of their assets, and charity would get a quarter of all of their assets. The bulk of their assets were being held in their IRA, their retirement funds. And those were written in equal shares to their daughters. And then the will controlled the rest of their estate. So even though they intended for their charity to get a quarter of the estate, the way their estate plan was written, the charity would only get a quarter of what was controlled by the will and none of what was controlled by the beneficiary statement in their IRA. Okay, so check those things. And the other thing that I always tell people or encourage people to do is that when you file your taxes, take an extra step and think about your estate plan and think about what has happened in the last year where you might you might need to change that plan. Was a grandchild added to your life? Was there a divorce? Did you purchase a new property? Whatever it happened to be, and then take another look at that estate plan. And you don't have to physically pull it out, but just kind of tick through those things and determine, do I need to update that this year? And you might say, nope, and then you're good. But one of the challenges is that as we progress through our lives, things change, and we want to make sure that our plans keep up with those. Kathy, that would be a question that I am not capable of answering. And Kathy's question in the chat is, for folks who have less than 2 million in total assets, is a will less efficient than a revocable trust? That would require me to offer an opinion, and I really can't. So I apologize for that. I don't think wills are a bad thing by any means. I think that they are a totally appropriate way to manage a smaller estate or a less complex estate. So an example would be Jim and Nancy Brown have 1 kid. Right now, a will would probably be very effective to take care of my 1 kid's need. Now, should he get married and have grandchildren, then I might look to do something a little bit different. So that's why it's really important for people to understand that everyone's situation is really unique. Okay. And we'll go back. And our next one is, so how would you use a will to pass, or a trust to pass on your assets? So I took an example of this estate where the gift goes in equal shares. So you can do that. And when you do that, you say, I've got 2 kids, so in equal shares to both children. You could do a specific dollar amount, and that might be because you have a favorite niece and you want that favorite niece to get something from your estate. So you carve out $25,000, $50,000, $5,000, $500, can be any amount that goes specifically to individuals. And another way is specific assets. You know, do you have a collector car that you want to make sure that your brother gets because you knew that he loved that car, or jewelry or furnishing? So you can identify specific assets that will go to specific individuals. And then another way is contingent bequests. So if your heirs don't survive, what's going to happen to it? Or and it might be that your siblings get whatever's left. So you always have the ability to do a contingency in a will or a trust. And with a will, If you don't have any contingencies and you don't have any heirs identified, then it kind of goes back into that whole hierarchy of who's next in line. And every state has a different next in line pattern, but typically if you didn't have any heirs, first it would go up, which means that it would go to your parents. And if your parents aren't surviving, then it goes to siblings and so on. So it gets taken care of, but it might not be how you want it taken care of. So if with a will or trust, it's really the same way. Now, the important thing to understand when you have specified bequests in your estate, those go first. So that gift to your niece of $25,000, that's going to be pulled off immediately. The specific asset, the jewelry, the furnishings, whatever it happens to be, that's going to be pulled off first. And then what's left after those specific dollar amounts follows all the other things. So that percent distribution, that contingency. I hope that makes sense. This is where I usually check to make sure that we're doing okay. So that's how using a will or a trust works. So beneficiary statements really are the same way. So let's say you have an IRA that's worth $100,000. You can indicate that it goes in equal shares to your children. You could say that actually you want a specific amount to go to one child and the remainder to go to another child. So you, again, have the ability to play with that. And the other thing you want to do is you always want to make sure that you have a contingent beneficiary. And this is where I like to pause and talk about charity as an appropriate contingent beneficiary. And the reason I say that is that frequently people will say, just leave my estate as my contingent. So basically what would happen is if you have no heirs, your beneficiaries are both deceased, and it now goes to your estate. Your estate is what is known as a non-qualified beneficiary, and it needs to liquidate that asset immediately. And if it's an IRA, a 401k, a 403b, where there's a lot of income that has built up that was never taxed, it's going to get taxed immediately. And because it's going to be a larger sum of money, it will probably be taxed at one of the higher income tax rates that are out there. So when you use a charity, if you don't have another human being, because that's what I always say, you want a human being to be your beneficiary, and I'll tell you why in a moment. But if you give it to charity, the charity is also a non-qualified beneficiary, and they're going to have to cash that asset out as well. However, a charity does not pay income tax, so they will get the full benefit of the assets that are in that tax-deferred vehicle. So going back now to the human being, why do you want a human being to be the recipient? Is they are qualified and they're capable of making decisions. And the decision is, do you want to cash that out, or do you want to stretch it? Unfortunately, recent legislation has taken away what used to be called the stretch provision of an IRA. And these are inherited IRAs. These are not spousal transfers, totally different. So Nancy Brown is gone and Isaac Brown now gets my IRA. He's the beneficiary. He's either going to cash it in or he's going to have to pull it out within 10 years. And that might not be right. Those two options might not be right for him, but that is all that the individual can do. And the reason that's happening is that the government wants those taxes. They've been deferred, so they want those taxes. So keep that in mind because we'll reference that later. So, you know what, I guess I would like to find out in the chat box, are we doing okay? Do we have questions or anything you want me to go back to? Okay. All right. So, all right. Dawn says doing okay. Thank you. So I talked about trying to understand that one of our goals was going to be understanding what is in your estate. And I hope that you have a better understanding of that and how they pass on to your heirs. And the next thing I said is, how can you use charity to help pass on gifts to your heirs? So I'm actually out of sequence here, so I'm going to move forward. And well, no, I'll stay here. So if you want to give a gift to charity, there are different ways that you can do it in your estate plan. We had talked about those specific dollar amounts in your will. And so remember, if you say that your favorite charity is going to get $25,000, that is going to be a first gift. So if your estate is only worth $30,000 and you want half your estate to go to your children, go equally to your children, what's going to happen is that that specific dollar amount is going to be gifted first, and all that's left is going to be the $5,000 and then split equally. So that's a little bit of a dramatic explanation or scenario, but when you have people who are highly philanthropic, very generous, and they have made an estate plan decades ago and they haven't kept up with it, this is something that can happen. The charitable gift or those specific assets will be taken first, and then it is inequitable or not what was intended for the heirs. So a specific dollar amount, you can say that, and like I said, that gets directed immediately. You can give a specific asset. So this example here says XYZ stock. So if you've been investing in Fastenal, I guess that's the best one for this area, and you want to give that to charity, you can say how many shares of that stock you want to give to charity. You can say a percentage of your estate can go to charity. And this is where you'd say 5% of net, 5% of gross, or you can leave the residual. And the residual is that after everything has been met, if there's anything that didn't get taken care of, whatever's left gets to go to the charities that you've identified. And I should say charities, because you can give to as many charities as you want. Many years ago, when I worked at UW Green Bay, we had an individual who had made many gifts to charity in his estate, and he loved those charities to know that he had done that. And when his time came and he passed and we got the will, he had given, I don't know, maybe 500 charities, anywhere between $50 and $500. It was just crazy, but that's what he did, and that's what his legacy was. Then there's the contingent bequest. And the contingent bequest is one of my former colleagues referred to it as the scorched earth bequest. And that's that if all my heirs predecease me and no one else can be found, I give my entire estate to charity. And like he called it, the scorched earth. It's pretty unusual that something like that would happen, but that can be one of the things that you incorporate into an estate plan, so it can benefit charity. Using your different assets that have beneficiary statements. So here we're looking at your IRA. It could be a mutual fund. Not a mutual fund, excuse me. That would be the transfer on death, excuse me. So your IRA, a life insurance policy, anything like that. And again, with the beneficiary statements, you can do that specific dollar amount. So let's say you have an IRA and you want to give a charity $25,000, you can actually indicate $25,000, and then that would be pulled out, and the remaining would then go to the other beneficiaries that you've identified. You can say a percentage. So is it a third? Is it 5%? Is it 2%? Whatever it happens to be, you can do that. And again, the contingent. And the contingent beneficiary is an important one because particularly with those assets that have taxes implicated, if they fall into your estate, they're going to get taxed at the highest income tax rate possible. So there you have beneficiary statements. So something that I didn't mention is that when you are looking at beneficiary statements, there was a time when nonprofit professionals had done a lot of work on talking about, hey, you've got a life insurance policy. Maybe you don't need that anymore because you're not subbing income that's lost because you were working at the time, but you have this policy, so why not consider gifting it to charity? At the same time, you may have an IRA, a 403B, 401k that has all of these taxes caught up in them. A life insurance policy passes without any kind of income tax tied to it. So you want to give that to your heirs first. If you're looking at benefiting charity, look to give the charity the one that has income taxes tied up in it, because that makes sure that you get more to your heirs. Okay. So here is an example of what that looks like. So if you look on the left, you have a bequest, what a bequest to charity would look like. And in here, we're saying we have an estate value of $2.5 million. And the assumption in that is that there are IRA, or income in respect of decedent is actually the terminology. So when that comes out, you're going to pay $210,000 based on a 30% tax rate. There is no estate tax. So you're going to pay that $210,000. And if your goal was to get $700,000 to charity, you have $700,000 going to charity, and your heirs get $1.59 million. And so because they lost $210,000 in income tax. So instead, if you give your IRA to charity, and that's the $700,000, I didn't do a good job of describing that, you see that you fulfill your charitable commitment by using that taxable asset, and your heirs will get more. They'll get 1.8 million simply because you chose a better asset to gift to charity. So this is an example of how it would look with an estate. So this is more of a graphic versus the chart. And in this particular case, you see that you have a retired couple. If you're looking in the upper left-hand corner, their house is about $200,000. They have a variety of investment accounts of $150,000. They have an IRA at $50,000 and life insurance for $100,000. They want to benefit charity. So keep in mind, this is about benefiting charity, or charities, I should say. So what you see is that when the first spouse passes, everything goes to the surviving spouse. And if they use the taxable asset to go to charity, $50,000 is going to charity, $450,000 is going to heirs, and the government isn't getting anything. Some people really like that. Okay, so that's one example. Another example, and this is going to be a more complex concept, and it's not something that's typical, And it really is something that takes some thought. But when I talked about how the IRS and the government has accelerated the payout of an IRA, and that may or may not be something that is good for your child or children. If you have charitable intent, a charitable remainder trust is a way to restore what was once called the stretch IRA. And what it's doing is it's getting your children or child or heir the asset that you want to get them, but in a more controlled fashion. We're probably in this particular area familiar with the oh my gosh, it's not Oneida, the Ho-Chunk over in Black River Falls. Very successful Native nation. And because of their gambling income, the members of that tribe get annual stipends from that. And that means anyone. So from a day old to however old. Well, those get put into trust funds. And when they turn 18, they have full access to those trust funds. And it's actually coined as 18 money. And what has happened is these 18-year-olds, as legal adults, have full access to their 18 money, those trust accounts. And you can see the data shows that those dollars don't last much beyond 4 years. And we're talking large, six-figure sums of money. They buy cars, they behave like an 18-year-old. And that is not unusual. And so if you have a child that may be 36 or 55 and they are a spendthrift, or they might have addiction issues, or they might have you might have concerns about their spouse's issues, you might want to look at doing something either in a trust or if you have that charitable intent, using this unique tool called a charitable remainder trust that is funded at death. And so when you look at this particular scenario, again, this is not an overly large size estate. It's not unusual for people's estates to get over $1 million very quickly. But in the left-hand corner, you have that $500,000 house, $500,000 in other assets, $1 million in IRAs, and life insurance at $1 million. So their total estate is $3 million. Again, the assumption is that everything falls to the surviving spouse. Now, at the second to die, if they do nothing with charity, the heir is going to get $2.7 million. The government's going to get $300,000. That heir may be a spendthrift, may be an addict, may be married to someone that has those tendencies, and $2.7 million could be dangerous for that person. And because you're concerned, there is something that you can do with this charitable remainder trust. And what it is that using that IRA asset of $1 million, it goes into this charitable remainder trust that is built on the assumption of it lasting for 20 years. Now, you can do it for the lifetime of the beneficiary. So it can be more than 20 years, but it cannot be less than 20 years. That's part of the IRS regulations around that. So let's assume that it is earning at least 5% and distributing 5% year in and year out. Over that 20-year period, they're going to get $50,000 a year. Yes, they pay income taxes on it, but not as much. It's tax favorable. That over time, they would see $700,000 coming out of that. So your heir still gets $2.7 million. The government gets nothing, and charity gets $1 million. Basically, what's happening is you're using the time value of money to parse those dollars out. You're benefiting your heirs over time, and you're benefiting the charity. the Winona Community Foundation was a beneficiary of, not that long ago, of a charitable remainder trust that was funded at the time of someone's passing. So let's say you have this IRA and you live so long that it's empty. So what happens? Do you have an obligation to the charity? Absolutely not. There is the only time that that trust gets funded is if there's dollars in it at the time of your passing. Kind of an interesting concept, a little bit complex, but again, that's something that I'd be more than happy to talk to you about. So we're bringing into the question time. And when I set this up, like I said, I was thinking that we're in a Zoom where we're going to be able to have a dialogue. So I apologize for that, but you can write those questions in the chat. And I also want to circle back and say, I'm not an attorney, not an accountant. I don't play one on TV even. This is just stuff that I really enjoy talking about because there's a lot of potential there to do really good things for your family, do really good things for charity, and be smart with your plans. There are lots of resources online that you can go to, but like I said, I am happy to have a conversation, whether it's for yourself or for someone you care about. Let me know what we can do. And I probably should have flipped it so you have our contact information here. And I don't know if you just want to give me it looks like you can do a smiley face in the chat, but I really do appreciate the time that you spent tonight to learn a little bit more about what makes up your estate, what's the good you might be able to do for your heirs and for charity at the same time. So again, thank you very much. And maybe next time we'll do a Zoom so we can have some good interaction. Oh, so Bob is asking about required minimum distributions to charity. Now that is definitely something that is out there and really wonderful. So if you don't know what that is that if you're age 72 and above and you have an IRA, the IRS has determined that you need to start taking minimum distributions because they want their money. And you may say, well, I don't need the entire distribution, or I don't need to take any this particular year. And the reason you're doing that is to control income taxes, because when they come out, and sometimes it's a large amount, it's going to be taxed. And so the required minimum distribution, there is now something called the qualified charitable distribution that allows someone, and actually you don't have to be at 72, but if you're 70 and a half, you can do this qualified charitable distribution, which is a gift directly to an operating charity. And so what you do is you talk to your IRA holder, and it has to be a qualified IRA. Can't do it with a 403B. You don't need to do it with a Roth IRA because you're not paying taxes on it, or a 401k. So it has to be a qualified IRA. And you just talk to your plan administrator and you say, please make a charitable distribution to my favorite charity, and they'll make it happen. Now, there are some caveats on that. So you want to make sure that it's going to an operating charity, that it's not going to like a social club or cemetery association, or in the case of a community foundation, it cannot go to a donor advised fund. It can go to the community foundation. It can go to any of its other funds. It just cannot go to a donor advised fund. There is a way to set up a fund that is qualified for a charitable distribution, but it needs to be done prior to you making that distribution. And we can work on a way to make it so it's benefiting the charities that you care about while meeting the intent of the law. So I hope that helped answer that question, Bob. There is some work at the legislative level that is hopefully going to bring down the age to 65 and the maximum amount to $400,000 a year. Right now, you can only do a $100,000 qualified charitable distribution. Well, we're at 6:52. I'm at 454-0441, nbrown@winonacf.org. And I hope you ask more questions. And if you have people who wish that they could have sat in on this, we are going to save it and be able to share it. So thank you very much and have a fabulous evening. Stay warm and healthy.